Navigating the stock market, a comprehensive guide to trading and investing. The stock market offers two primary avenues for wealth creation: trading and investing. While their end goal profits the same, their philosophies, strategies, and required temperaments are worlds apart. The most fundamental difference lies in their relationship with time. Trading seeks to profit from short-term price movements, offering potential gains in minutes, days, or weeks. Investing, in contrast, is a long-term partnership with the business, where profits are realized over years or decades through sustained growth and compounding. Before diving into either, it's crucial to understand that one individual can wear both hats. However, success in either field demands a clear distinction between the two mindsets. Core concepts explained through a story. To demystify these concepts, consider the story of Baburao, a mobile shop owner. His thriving business is disrupted when Total Seth opens a rival shop, selling the same phones for less. Baburao loses all his customers. Watching the news, he learns that a popular phone brand Z will face a supply ban due to a chip shortage, even as demand remains high. Baburao spots an opportunity and has two choices: the trading approach, each morning; the investing approach. He buys Total Seth's phones in bulk, stores them in a warehouse for several months, and waits. When the supply crunch hits and market prices soar to 12,000, he sells, realizing a larger delayed profit. In this analogy, the first action is trading capture and profit from short-term arbitrage. The second is investing committing capital with patience to benefit from long-term value appreciation. In the stock market, phones are replaced by shares, but the principle remains identical. The investor's mindset, ownership, and analysis. An investor acts as a partner of a business. Their process begins with fundamental analysis, a deep dive into a company's financial health, management quality, competitive advantages, and industry prospects. They ask, is this a good business? Will it grow over the next decade? Once convinced, they invest with a long-term horizon. The investor's return comes in two forms: capital appreciation, the increase in the share price over many years as the company expands and earns more; dividends, periodic payouts of a portion of the company's profits to shareholders, providing an income stream. For many, this dividend income alone can grow to substantial sums over time. The company uses invested capital to innovate, hire, and grow, which in turn increases its value, a virtuous cycle for the patient investor. The trader's mindset. Exploiting volatility. A trader is indifferent to the company's long-term story. Their focus is purely on price action. They employ technical analysis, studying charts, patterns, and indicators to predict short-term price movements. A trader might buy a share in the morning because a chart suggests an upward trend and sell it by afternoon for a gain. Regardless of what the company does, trading is inherently a zero-sum game. For every trader who profits by selling high, another loses by buying at the peak. It is fast-paced, requiring constant screen time and quick decision-making. Key distinctions at a glance. Parameter trading: investing. Time horizon: short-term seconds to months, long-term years to decades. Primary goal: profit from price volatility, wealth creation via growth and compounding. Analysis method: technical analysis, charts, trends, fundamental analysis, business health, risk profile: very high, speculative, volatile, moderate to low, mitigated by time. Activity level: high active, daily monitoring, low passive, periodic review. Stress and emotion: high stress, emotional roller coaster, lower stress. Requires patience, capital required, can start small, but risks and magnified benefits from starting early. Compounding works best. Costs involved: higher frequent brokerage. STCG taxes approximately 30% lower in frequent costs. LTCG taxes approximately 10%. Core skill: market psychology and timing, business analysis, and patience. Critical considerations: risk, psychology, and costs. Risk and psychology. Trading is psychologically taxing, marked by stress, greed, and fear. The pressure of constant wins and losses is intense. Investing requires the psychological fortitude to endure market downturns without panic, trusting in the long-term thesis. The power of compounding. This is the investor's secret weapon. Reinvesting earnings generates returns on returns, leading to exponential growth over decades. Trading rarely benefits from this mathematical marvel. The cost factor. Frequent buying and selling in trading accumulate significant brokerage fees and attract higher short-term capital gains taxes, approximately 30% plus. Investing, with its buy-and-hold approach, minimizes transaction costs and benefits from lower long-term capital gains taxes, approximately 10%. The learning curve. Statistics are sobering. A vast majority of new traders lose money, often within their first few months. Investing has a more forgiving learning curve, focused on understanding businesses and economic cycles rather than predicting minute-to-minute price swings. The ultimate question: trading or investing? The answer depends entirely on your personality, goals, and circumstance. You should primarily invest if you're a beginner learning the markets, a salaried professional seeking to build wealth for future goals, retirement, education. someone with limited time to monitor the markets daily, risk-averse and susceptible to stress, convinced of the long-term growth of the economy. You may cautiously explore trading only if you have a solid foundation in market basics and a well-established investment portfolio. Understand it's a skill that requires dedicated study like any profession. Have risk capital money you can afford to lose completely without impacting your lifestyle or financial goals. Possess the temperament to handle stress and strict discipline to follow risk management rules. A prudent path forward. For anyone new to the stock market, the journey must begin with investing. Start by learning the basics of financial statements, valuation, and economic principles. Open a demat account. Begin with a small amount in a diversified portfolio or mutual funds, and focus on the long term. If, after gaining experience and securing a financial foundation, you wish to explore trading, do so with extreme caution. Allocate only a tiny, discretionary portion of your capital. Choose a reliable, user-friendly broker with transparent charges. In conclusion, while trading promises excitement and quick results, investing offers a proven path to sustainable wealth creation. Most successful market participants are, at their core, long-term investors. They may allocate a small fraction to trading, but their financial security is built on the bedrock of patient, disciplined investing. Your first step is not to choose between them, but to firmly establish yourself as a competent investor. The rest is a strategic choice, not a necessity. If this comprehensive guide helped clarify your path in the stock market, please like, share, and subscribe. Your engagement supports the creation of more in-depth, actionable content to help you on your financial journey. Thank you for reading.